Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. Disney can't seem to get a lot of love from investors, and as we go through this battle in the streaming wars, the decline of cable, Disney seems to be one of the stocks that's kind of out of favor in the market. But I think there's actually a lot to like about the company, its position, and where it may be going in the future. So I want to dig into some of the numbers, some of the trends that I see that I think the market is overlooking. My name's Travis William. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. Check out my newsletter, Asymmetric Investing. Got a link to that in the show notes. And I want to start with some of the core numbers from Disney because I think we need to think about this business very differently than we did over the last decade. Cable, ESPN, not going to be driving results. What is going to be driving results is parks. This is the most recent quarterly results from the second fiscal quarter of the year. You can see the number on the right is the 6-month number. So $5.2 billion of operating income from the park. So about a $10 billion operating income run rate, whereas the media and entertainment division, only $1.1 billion. That's where you see the losses in streaming, the loss of profitability on the cable networks. That's really starting to hit this media business. But the strength for Disney right now is the revenue and cash coming from Disney parks, experiences, and products. Here's where you can see where the numbers are coming from the media side. On the bottom is the operating income statement, the linear networks. So this would be ABC, ESPN, the Disney Channel, things like that. They're still generating a lot of cash, but that cash is being burnt from direct to consumer. That's really the streaming business. $1.7 billion in losses there in the first half of the year. But there is some good news. And this is the thing that I think investors are overlooking right now. There's a lot of opportunity for growth for Disney if you look at the entire suite of products that it has. Disney Plus is the one product that we often think about with Disney, and that's a very important product. Over 100 million subscribers in the core markets, another 53 million subscribers on Disney Hotstar. That's something they're going to be de-emphasizing because you can see that average revenue per user, only 59 cents in the most recent quarter for Hotstar. So that's going to get a lot less investment in the future. Where they're going to focus is this core business, $6.47. That's still well below what Netflix is charging. And Netflix has about twice as many subscribers. So a lot of opportunity for growth for Disney Plus. And we haven't seen any significant revenue from advertising, which is something we know is coming. But Disney Plus is not the only streaming service. Hulu is actually one of the bigger streaming services in the world, and Disney is going to actually be acquiring the part of Hulu that it doesn't own. So that will add a significant number of subscribers, and management has said that they will lump together the Disney Plus, Hulu, and these ESPN Plus apps into a single app experience probably later this year. So between those three apps, if you add all the subscribers together, you have over 200 million subscribers. Maybe not 200 million discrete subscribers, but that's the number. And the revenue for Hulu is really impressive. Video on demand, $11.73 per subscriber. And then you add in live TV, you're talking about almost $100 per subscriber. ESPN Plus, much smaller business, much lower price, $5.64. But 25 million subscribers. So keep these numbers in mind as I go through some of the ways to think about the strategy for Disney going forward. And one thing I think we need to think about is how much time people are spending on Disney streaming, because it's maybe a bigger percentage of the streaming picture than you might think. This data is from Just Watch, and none of these companies officially release data, so they're all kind of pulling information from different sources. This one says that Prime is actually the most watched, followed by Netflix and Max. But if you add up Disney and Hulu, they would actually be the most watched streaming services with those two added together. They would have over 20% market share in the US. This is data pulled together by Alex Morris from the Science of Hitting, and this is Nielsen data. But again, you see a similar story. Netflix and YouTube are actually the big players, and then followed by Hulu in the gray, 3.5% of streaming hours, and Disney with 2%. So based on these numbers from Nielsen, you're talking 5.5%. That would be the third biggest streaming service behind Netflix and YouTube. Not a market leader, but definitely a very good position for Disney to be in. So why is this important for investors? Don't think about where Disney is today. Think about where Disney might be in 5 to 10 years. As we have these battles and who's going to be a winner in streaming and who's not, everybody has their own streaming service. But I don't think in the future that's going to be the case. Netflix is clearly a leader. YouTube has its own place with user-generated content. But I think Disney can be the third player there. You add together Disney Plus, Hulu, and then ESPN Plus, and you start to get a really compelling offering. We also know that ESPN itself is going to be going over the top. So maybe that will be bundled in as well. The pricing power comes from all of the content that is in all of those services. One of the challenges that Netflix has had recently is that they're running into the inability to raise prices because it's relatively easy to cancel and there's not all that much specific compelling content on Netflix. If you bundle together Disney Plus, Hulu, and ESPN, now you start thinking about charging prices that drove cable prices higher. So ESPN has games on every night. That's maybe not something that you're going to be able to cancel. So churn may go down. Prices may go up. They're also going to be able to add advertising. A lot of the subscribers for Hulu are already used to watching advertising. Netflix has built its brand on not having advertising at all. So now that they're adding advertising in some of their tiers, it's kind of a jarring impact because it's not something you're used to with Netflix. That's not the case with a lot of these Disney services. Specifically with ESPN, people are just used to watching ads. Ads monetize relatively well in streaming services. Bob Iger, CEO of Disney, has said that. Netflix has said that in the past. We'll see if they're able to transfer that to Disney Plus. But I think the combination of those three apps is a really valuable position to be, and you have a lot of growth opportunities. Not only can you grow the user base, but you can grow revenue by increasing the price that you're charging for the service and adding on advertising. We are in the very early innings of this long-term picture for Disney, and we may have streaming losing money today, but I don't think that's going to be the case a whole lot longer. Disney is cutting costs, they're adding new sources of revenue, and they're really building a strategy, I think, to win in streaming, at least be one of the top 2 or 3 players. And long term, that will be a great position to be. The wonderful thing for investors is they have that core entertainment and parks business to generate cash and actually fund any of these businesses until they get to cash flow positive. So I think there's actually a lot to like about Disney long term. 5 to 10 years from now, this is going to be a leader in streaming. They may actually be aggregating content from other producers, not just showing content from their own studios. It'll be like its own mini cable bundle. So the market may not see that vision today, but I think it's pretty clear that's what Bob Iger is laying out. I think there's a lot more to like about Disney than a lot of investors think. But what do you think? Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.